Have you ever thought about starting a business? Or maybe you've thought about investing in stocks? To do either of these, there are 3 reports that you need to know about back to front. The income statement, the cash flow statement, and the balance sheet. These statements are generally referred to as your financial statements. So why bother with these? Well, if you want to know where your business's money is going, or where the money is going in a business you're thinking about investing in, then you need to bother with these statements. In this episode, we'll be delving into an overview of the first financial statement, the income statement. My name is Jake Owens, and this is Millionaire Mindset Hub. Alright, let's get into it. So you might be wondering why we use an income statement, and that's a really good question. We use an income statement to drill down on specific periods of a business, which is usually a month, a quarter, or a year. We then categorize the business's results to find out where we may be overspending or where our revenues are actually being generated from. Another reason for why we use this statement is to find out a business's net profit or loss. Okay, so now you know why an income statement is used. So what does an income statement show? The income statement shows 3 things: the business's revenue, expenses, and the net profit or loss, also sometimes referred to as your bottom line. Now, your revenue is all of the income that a business generates. For example, the money a customer gives you when you sell a product, or the money a client gives you when you offer a service. Your expenses, on the other hand, is all the money the business spends. For an example, on your office's lease or on your employees' salaries or wages. And lastly, your bottom line, or in other words, your net profit or loss. This is a simple subtraction where you take all of your revenues and subtract all of your expenses. And this gives you a number, either positive or negative, showing how much profit or loss the business made in a specific time period that your income statement is looking into. Let's now look at how an income statement is put together. Now bear in mind, the way an income statement is put together can vary largely, depending on the company creating it. So bearing that in mind, I'm going to give you an overview, but it may not cover everything you come across when analyzing one. At the top of an income statement, it will show 4 things: the company's name, stating that this report you're looking at is in fact an income statement, the time period this income statement is looking over, and if the numbers written on the statement are in tens, hundreds, thousands, millions, or billions. Under this, the first section of the income statement will be the business's total revenues in the declared time period. So now that this has been declared, everything coming after it will be subtractions of that number. So unlike a good novel, with an income statement, you'll end up getting sadder and sadder the further down the page you look. A common thing to see in the revenue section of a company that sells products is something called a cost of goods sold. What this is essentially in its name. It's the direct cost you had in order to sell all of your products. A good example of these costs is the purchase price of the product to be resold, or the distribution costs to get products to your business's retail stores. After working out your cost of goods sold, you need to take the total revenue that you declared at the top of your income statement and subtract the cost of goods sold that you just worked out. This will give you a subtotal called the gross margin, otherwise known as your gross profit. Next, we delve into the expenses which aren't directly related to the product, but are related to the operation or not the operation of the business. These are called operating and non-operating costs. The difference between your operating costs and your non-operating costs is that your operating costs are what is directly related to operating your business, whereas your non-operating costs aren't. An example of an operating cost would be the wages or salaries for your employees, because without them, your business wouldn't be able to operate. Whereas an example of a non-operating cost could be the legal fees of a lawsuit. Sure, these expenses help keep your business's doors open, but in terms of operation, they wouldn't be classified there. You then take the total number after adding together your cost of goods sold and operating costs. subtract that number from your revenues, and from that get your operating profit. Then, after taking that number and subtracting your non-operating expenses, you get your earnings before tax, which can also be called your income before tax. On an income statement, near the bottom after your income before tax, you will see a section dedicated for tax expenses, where the amount of tax paid will be shown. To find your net profit, which will be located at the bottom of any income statement, you take your earnings before tax, subtract the taxes you have paid on those earnings, and then the number given to you is the net profit or loss the business has made for the time period this income statement is looking at. And this is the basics of how an income statement is put together. In conclusion, the income statement is vital to any business or investor and should never be overlooked as a just another formality. I hope you guys have enjoyed this episode. If you did, make sure to like the video and subscribe to the channel. My name is Jake Owens, and this is Millionaire Mindset Hub. Alright, I'll see you in the next video. Cheers.